One mine in the Democratic Republic of Congo produced over $1.8 billion worth of cobalt in a single year. That's $4.9 million every single day, more money than most companies make in months, generated from pulling metal out of the ground at a single operation. And here's what makes this even more shocking. This mine shut down completely at the peak of the electric vehicle boom, then restarted years later, reshaping the entire global battery supply chain both times. Welcome to Mutanda, where geology meets geopolitics, and one company's production decisions can make or break the global transition to electric transportation. I'm about to show you how Glencore's Mutanda operation became more powerful than entire governments when it comes to controlling the material that makes your phone, laptop, and electric car possible. By the end of this video, you'll understand exactly how 20% of the world's cobalt supply, concentrated in one location, gives a single company the power to influence battery prices, automaker strategies, and international trade policy. The smartphone in your pocket contains roughly 8 grams of cobalt. Your laptop has about 30 grams. But an electric vehicle? That battery pack contains anywhere from 5 to 15 kilograms of cobalt metal, depending on the chemistry. Multiply that by the 100 million vehicles the world produces annually, and you start to understand why cobalt matters. Every major automaker, Tesla, Ford, General Motors, Volkswagen, Toyota, needs thousands of tons of cobalt every single year to meet their electric vehicle production targets. And until 2019, 1 in every 5 cobalt atoms in those batteries came from this single mine in Central Africa. Think about that concentration of supply for a moment. One operation, one company, one decision point for 20% of a critical material with no easy substitutes. Mutanda sits in Lualaba province in southeastern Democratic Republic of Congo, roughly 250 kilometers northwest of Lubumbashi, the provincial capital. This region holds over 50% of the world's known cobalt reserves, 3.5 million tons of cobalt metal locked in the ground. The concentration isn't random. This is the Central African Copper Belt, one of Earth's most extraordinary geological provinces, where ancient seas deposited sediments that were later mineralized with copper and cobalt in concentrations found almost nowhere else on the planet. Glencore, the Swiss mining and trading giant with a market capitalization exceeding $50 billion, operates this massive open-pit complex. The company is one of the world's largest commodity traders and producers, generating over $200 billion in annual revenue from metals, minerals, and energy products traded globally. Within Glencore's portfolio, Mutanda became their crown jewel in the battery metal space. But the company's cobalt business extends beyond this single mine. Glencore also operates Katanga Mining and owns stakes in other Congolese copper-cobalt operations, making them the world's largest cobalt producer by a substantial margin. But here's where the story gets interesting, and this is the first major question you should be asking. Why would the world's largest cobalt producer voluntarily shut down their biggest mine in 2019, when electric vehicle demand was exploding? The answer involves strategic market manipulation worth billions of dollars, and I'll reveal exactly how Glencore pulled it off. But first, you need to understand just how dominant Mutanda had become, because the production numbers are staggering. At peak output in 2018, this single operation produced 27,300 tons of cobalt metal. Let me give you context for that number. Total global cobalt production that year was approximately 140,000 tons, meaning Mutanda alone represented 19.5% of everything the entire world produced. Mutanda wasn't just big. It was producing more cobalt than entire countries with established mining industries. The mine's output exceeded the combined cobalt production of Russia, Australia, and Cuba together. One operation outproduced 3 nations. And here's what makes that even more remarkable. Cobalt is a byproduct at Mutanda, not even the primary target. This is fundamentally a copper-cobalt deposit, and the mine produced 213,000 tons of copper in that same peak year of 2018. The copper business alone generated over $1 billion in revenue. But cobalt commanded the premium that made this operation extraordinarily profitable. Let me walk you through the financial math that drove Mutanda's economics during the boom years, because understanding these numbers explains everything that happened next. In 2018, cobalt prices averaged around $66,000 per ton for most of the year. Some of you might remember the spike to over $90,000 per ton in April 2018. We'll discuss what caused that surge and subsequent crash. But at the $66,000 average, do the math on 27,300 tons. That's $1.8 billion in cobalt revenue alone from this single mine in 1 year. To put that in perspective, that's more than the entire GDP of several African nations. More revenue than some Fortune 500 companies generate, from one hole in the ground in Congo. Add the copper production at roughly $6,500 per ton average, and you're looking at another $1.38 billion in copper revenue. Combined, Mutanda generated over $3.1 billion in annual revenue at peak production from just these two metals. Total revenue approaching what it costs to build a semiconductor fabrication plant or launch a major satellite constellation. Now, revenue isn't profit. Let's be precise here with Bloomberg-level accuracy. Glencore's total cobalt business, which included Mutanda, plus their Katanga operation and other Congo assets, generated EBITDA margins around 30–40% during the boom years, when cobalt prices exceeded $50,000 per ton. But operating costs at Mutanda were climbing significantly through 2017 and 2018. The mine's all-in sustaining costs by 2018 had risen to approximately $20,000 to $25,000 per ton of cobalt produced, depending on how you allocate costs between copper and cobalt. That might sound reasonable against a $66,000 selling price. You're looking at margins of $40,000 to $45,000 per ton, which translates to over $1 billion in operating profit at peak production rates. But here's where the accounting gets complex and ultimately drove critical decisions. Cobalt is recovered as a byproduct of copper mining at Mutanda. You're not selectively mining cobalt-rich ore zones. You're mining copper ore that happens to also contain economically significant cobalt concentrations. So how do you allocate mining costs, crushing costs, and processing costs between the two products? Different accounting methods produce different cost figures. If you allocate costs by revenue contribution, cobalt looks incredibly profitable. If you allocate by tonnage produced, copper bears most of the cost burden. If you use net realizable value allocation, the split changes again depending on relative metal prices. This cost allocation question would ultimately drive the closure decision in 2019, but we're getting ahead of ourselves. First, you need to understand the sheer physical scale of this operation, because Mutanda is among the largest mining complexes in Africa by footprint and material movement. Mutanda is an open-pit mine with multiple pits: Kansoko, Mashitu East, Mashitu West, Dezuwa, and others, spread across a mining license covering approximately 1,850 square kilometers. To give you a comparison, that's larger than the entire city of London, bigger than the area inside the M25 motorway. The main pits descend hundreds of meters into copper-cobalt ore zones hosted in sedimentary rocks of the mine series formation. These aren't underground operations where you follow narrow veins. These are massive open pits where you strip away everything above the ore body, then mine the mineralized rock in benches that spiral down into the earth. At peak operations, Mutanda moved over 60 million tons of material annually. That's roughly 165,000 tons every single day. Picture a train of ore trucks stretching from Washington, D.C. to Baltimore every single day. Of that 60 million tons, roughly 15 to 18 million tons was actual ore sent to processing, with the balance being waste rocks stripped away to access the ore. The ore grades at Mutanda are spectacular by global standards, and this is what makes the operation economically viable, despite being located in a region with challenging infrastructure. The deposit averages around 1.2% to 1.5% copper and 0.4% to 0.5% cobalt in the zones being mined. If you're not familiar with mining, those percentages might not sound impressive. But in mining economics, grade is everything. It determines whether a deposit is ore or just rock. For context, most large copper mines worldwide operate at grades between 0.3% and 0.8% copper. And here's what makes Mutanda truly exceptional. Typical copper deposits might contain 0.01% cobalt or less, as a trace element that's often not even recovered. Mutanda's ore is 40 to 50 times richer in cobalt than typical copper deposits worldwide. This concentration is what transformed cobalt from an interesting credit into a primary revenue driver. The processing operation at Mutanda uses heap leaching and solvent extraction electrowinning technology, abbreviated as SXEW in the industry. This is critical to understand because the metallurgy directly impacts costs and explains why Mutanda can process lower-grade copper ore economically compared to smelting operations. Crushed ore is stacked in massive heaps on impermeable pads, typically in lifts 20 to 30 meters high. These heaps can cover areas equivalent to dozens of football fields. The ore is then irrigated with sulfuric acid solution that percolates through the heap, dissolving the copper and cobalt from the ore into what's called pregnant leach solution. That solution is collected in ponds and pumped to the solvent extraction plant, where copper is selectively separated first using organic reagents that preferentially bond with copper ions. The copper-loaded organic solution is then stripped with stronger acid, and the resulting copper-rich solution goes to electrowinning, where metallic copper is plated onto cathodes. The remaining cobalt-rich solution from the copper circuit moves to the cobalt processing circuit. Here, additional solvent extraction stages purify the cobalt, removing impurities like iron, manganese, and other metals. The purified cobalt solution then goes to cobalt electrowinning, where it's plated out as pure cobalt metal cathodes, weighing roughly 50 kilograms each. The infrastructure supporting this operation is staggering in scale, and represents hundreds of millions of dollars in invested capital. Mutanda employed roughly 5,000 people directly at peak operations: engineers, geologists, plant operators, equipment operators, maintenance technicians, laboratory staff, administrative personnel, and management. Add thousands more in contractor positions: drilling crews, blasting contractors, hauling contractors, maintenance contractors, catering services, security personnel. During peak operations, the total workforce at the mine site and in surrounding service areas easily exceeded 10,000 people whose livelihoods depended directly on Mutanda. The power consumption runs into hundreds of megawatts. The crushing plants, conveyor systems, pumping systems, solvent extraction plants, and electrowinning facilities all require enormous amounts of electrical power. That power comes primarily from the regional grid, fed by hydroelectric dams on the Lualaba River, supplemented by diesel generators for backup and peak demand. Now let's rewind the clock and understand how this giant came to exist, because Glencore didn't discover Mutanda. They recognized an opportunity and had the capital and expertise to develop it at scale. The Mutanda deposit was known for decades, but large-scale modern development began in the early 2000s. The Democratic Republic of Congo had been racked by civil war and conflict through the 1990s and early 2000s. As the country began stabilizing in the mid-2000s, mining companies started investing again in the copper belt, which had been severely neglected during the conflict years. Glencore acquired their stake in Mutanda through a complex series of transactions. In 2007, Glencore purchased a controlling 40% stake in the project for approximately $500 million from a group that included Rowney Assets Limited, a company with connections to Israeli businessman Dan Gertler, who had extensive business interests in Congo. The timing of this acquisition was brilliant from Glencore's perspective. The 2000s saw an explosion in portable electronics, laptops, smartphones, tablets, all requiring lithium-ion batteries containing cobalt. Simultaneously, Tesla had just launched the Roadster, and the electric vehicle industry was being born. Cobalt demand was entering what analysts call a structural growth phase, where fundamental factors drive sustained demand increases over years or decades, not just cyclical ups and downs. Glencore's management, led by CEO Ivan Glassenberg, recognized this trend early and moved aggressively to secure cobalt supply. By 2008, Glencore had increased its ownership to 100% of Mutanda Mining SARL, the operating company. The purchase price for the remaining 60% hasn't been publicly disclosed, but given the subsequent value creation, it was likely one of the shrewdest mining acquisitions of the 2000s. Glencore began aggressive expansion immediately, investing hundreds of millions of dollars to scale up production from the existing operations. Initial production in the mid-2000s was modest, perhaps 5,000 to 8,000 tons of cobalt annually from relatively small-scale operations. The Glencore had the capital, the technical expertise, and critically the global trading network to transform Mutanda into something unprecedented in the cobalt market. The company's trading arm could secure long-term offtake agreements with refiners and battery makers, providing revenue certainty that justified expansion investments. The expansion accelerated through the 2010s as cobalt demand kept growing. New pits opened. Kansoko came online, followed by Mashitu East, then Dezua. Processing capacity expanded in phases, with new crushing plants, expanded heap leach pads, and additional SXEW lines commissioned. Production soared. By 2013, Mutanda was producing over 16,000 tons of cobalt per year, making it one of the world's top 3 cobalt operations. By 2015, output had increased to 20,000 tons. By 2016, production hit 24,500 tons, and Mutanda was definitively the world's single largest cobalt mine. The peak came in 2018 at 27,300 tons of cobalt, making Mutanda far and away the world's dominant source of this critical battery metal. No other cobalt mine worldwide came even close to matching this output. The second largest cobalt mine produced perhaps half of Mutanda's tonnage. But 2018 was also the year the cobalt market experienced a dramatic and devastating price collapse that would ultimately lead to Mutanda's closure. Understanding what happened requires examining the supply-demand dynamics that created both the boom and the bust. Cobalt prices had been rising steadily through 2016 and 2017 as electric vehicle announcements proliferated and battery manufacturers expanded capacity. By late 2017, cobalt was trading around $60,000 per ton, up from $30,000 per ton just 2 years earlier. Then, in early 2018, prices surged dramatically. By April 2018, cobalt hit over $90,000 per ton, triple the price from 3 years earlier. The driver was panic buying by Chinese battery manufacturers and speculators, who believed cobalt would be permanently supply constrained. Media reports about cobalt scarcity proliferated. Analysts issued reports projecting cobalt deficits extending years into the future. Some forecasts suggested cobalt could hit $100,000 or even $150,000 per ton if electric vehicle adoption accelerated faster than new mine development. What happened next is a textbook example of how commodity markets work. High prices solve supply problems. The $90,000 price incentivized every marginal cobalt source to ramp production. In Congo, hundreds of small-scale artisanal miners flooded into cobalt-rich areas, hand-digging ore and selling to intermediaries. Industrial operations accelerated development plans. Glencore pushed Mutanda to maximum production. Other mining companies fast-tracked cobalt projects that would have been marginal at lower prices. Chinese companies invested billions in cobalt refining capacity, further incentivizing mine production. The result was predictable. By mid-2018, cobalt supply growth was outpacing demand growth. Prices began falling. $80,000 per ton by June, $60,000 by September, $40,000 by November. By December 2018, cobalt had crashed to below $30,000 per ton. The price had collapsed by 67% in 8 months, one of the fastest and steepest crashes in modern commodity markets. Battery manufacturers who had panic bought at $80,000 or $90,000 per ton were sitting on enormous losses. Speculators who thought they were riding the EV boom to riches got crushed. For Mutanda, this price collapse fundamentally changed the economics. Remember those costs of $20,000 to $25,000 per ton I mentioned earlier? Those were calculated when copper prices were strong, and costs could be favorably allocated between the two metals. As cobalt prices crashed toward $30,000 per ton, the cost allocation equation changed. If you're selling cobalt for $30,000 and copper for $6,000, but your all-in costs are $20,000 per ton of cobalt, your margins have compressed dramatically. At $30,000 cobalt, you're looking at perhaps $10,000 per ton operating margin, or roughly $275 million annually. Decent, but not spectacular. And that's before accounting for sustaining capital expenditures, corporate overhead, taxes, and royalties. The DRC charges 3.5% royalty on cobalt, plus a 10% free carried government interest, plus 30% corporate tax on profits. After all deductions, the return on capital employed was looking marginal. Meanwhile, Glencore's other major cobalt operation, Katanga Mining, was completing a major brownfield expansion that would add thousands of tons of annual cobalt production. The company was facing a strategic choice: keep Mutanda running at compressed margins, or take a different approach. By mid-2019, Glencore CEO Ivan Glasenberg and the board faced a critical decision. Cobalt prices were still depressed below $35,000 per ton, and more supply was coming from competitors. The company had already announced publicly that it would cap total cobalt production across all operations at 30,000 tons per year. But the market wasn't responding. Prices kept drifting lower through 2019. More artisanal supply kept flooding in from Congo. Chinese refiners kept expanding capacity. The supply-demand balance was oversupplied, and someone needed to cut production to rebalance the market. Glencore made a decision that sent shockwaves through the battery metals world. In November 2019, the company announced that Mutanda would be placed on care and maintenance, mining industry terminology for temporary closure. Production would cease. The world's largest cobalt mine would go silent. The official reason cited in Glencore's press release was straightforward. Low cobalt prices and high operating costs made continued operation uneconomic. But the strategic implications were immediately obvious to everyone who understood commodity markets. Removing 27,300 tons from a market producing 140,000 tons would tighten supply by nearly 20% overnight. Some analysts accused Glencore of market manipulation, intentionally cutting supply to drive prices higher. Glencore denied this, pointing to legitimate economic rationale, but the effect was undeniable. Cobalt supply would decline substantially, and assuming demand continued growing, prices would have to rise. Care and maintenance meant the mine would be preserved, but not operated. Critical equipment would be maintained in working order. Pits would be secured and dewatered as needed. A skeleton crew of perhaps a few hundred employees would remain on site to maintain infrastructure and security, but no ore would be mined, crushed, leached, or processed. No cobalt metal would be produced. The economic impact on the local region was immediate and severe. 5,000 direct jobs disappeared as workers were laid off. Thousands of contractor positions evaporated as drilling crews, hauling contractors, and service providers lost their largest customer. The economic ripple effects devastated the local area. The town of Kolwezi, which had grown prosperous, servicing Mutanda and other nearby mines, saw economic activity plummet. Restaurants, shops, hotels, and service businesses that depended on mine workers and contractors suddenly had no customers. Property values declined. Tax revenues collapsed for local government. For the Congolese government, the closure was a disaster. Royalty revenues from Mutanda, over $60 million annually at peak production and prices, vanished. Corporate tax payments stopped. The 10% government ownership stake in Mutanda Mining SAR was now an interest in a non-operating asset producing zero cash flow. The DRC government objected to the closure, but ultimately had limited leverage. Under the mining code, companies have the right to place operations on care and maintenance if they become uneconomic. The government could make it difficult, but they couldn't force Glencore to operate at a loss. This highlights a fundamental tension in resource-dependent economies. Governments need the tax revenue and employment that mining provides, but they don't control production decisions. That power resides with the mining companies who own and operate the assets. The DRC needs Glencore more than Glencore needs any single mine in Congo. But globally, the cobalt market responded exactly as Glencore might have hoped. Prices stabilized in early 2020 around $35,000 per ton. The psychological floor had been established. If prices fell much further, Glencore could idle even more production, which would tighten supply further. By mid-2020, as COVID-19 disrupted industrial production and supply chains globally, cobalt supply from some African operations was interrupted. Prices began climbing again, reaching $40,000 per ton by late 2020. Then, 2021 brought the electric vehicle revolution into full force. Tesla's sales exploded from 500,000 vehicles in 2020 to over 900,000 in 2021. Every major automaker announced massive EV production targets. General Motors committed to only electric vehicles by 2035. Ford announced $50 billion in EV investments. Volkswagen targeted 50% electric sales by 2030. Suddenly, the world needed cobalt more desperately than ever. Battery manufacturers were scrambling for supply. Long-term contracts were being negotiated at premium prices. By mid-2021, cobalt prices had recovered to over $50,000 per ton and rising. Battery manufacturers and automotive companies were panicking about supply security. The cobalt shortage that analysts had predicted years earlier was finally arriving, not because demand had surprised to the upside, but because Glencore had removed 20% of supply from the market by idling Mutanda. And Glencore held the trump card. Everyone in the industry knew Mutanda could restart. The mine wasn't depleted. It had decades of reserves remaining. The infrastructure was maintained. The processing plants could be refurbished. All that was needed was an economic incentive, and by late 2021, that incentive clearly existed. In December 2021, Glencore made the announcement the market had been anticipating for months. Mutanda would restart operations. Production would resume in the fourth quarter of 2022, with ramp-up continuing through 2023. The world's largest cobalt mine was coming back online. The restart decision came after cobalt prices had sustained above $50,000 per ton for months, reaching $75,000 per ton at peak in 2021. At those price levels, even with higher operating costs than 2018, Mutanda's economics worked beautifully. Glencore projected the mine would produce around 20,000 tons of cobalt annually after restart. Why not return to the peak 27,300 tons? Because the mine plan changed substantially. Glencore would focus on higher-grade ore zones and optimize for profitability rather than maximum volume. Mining lower-grade zones that were processed during the boom years no longer made economic sense. At 20,000 tons annually and $50,000 per ton, you're looking at $1 billion in annual cobalt revenue, a substantial business by any measure. Add copper production, which would also restart, and Mutanda would generate well over $1.5 billion in annual revenue at 2021 prices. The restart investment required approximately $700 million in capital expenditure, according to Glencore's disclosures to investors. This included refurbishing processing equipment that had been idle for nearly 3 years, reopening pit faces, hiring and training workers to replace the 5,000 who had been laid off, and rebuilding supply chains that had been dormant. The equipment that sits idle deteriorates, seals dry out, bearings corrode, electrical systems degrade. The solvent extraction equipment, pumps, tanks, and electrowinning cells all required inspection, maintenance, and in many cases, component replacement. The $700 million restart cost was substantial, but justified by the revenue potential. Production resumed in late 2022 as planned. By 2023, Mutanda was back online, producing cobalt for a market that desperately needed it. The mine ramped up gradually over the year, with production reaching approximately 18,000 tons of cobalt in 2023. The financial impact on Glencore was significant. The company's share price, which trades on the London Stock Exchange under ticker GLEN, responded positively to the Mutanda restart announcement. Investors recognized that bringing this asset back into production would generate substantial cash flow as cobalt prices remained elevated. Now let's zoom out and understand Mutanda's role in the broader Democratic Republic of Congo economy, because mining dominates this country's export economy and government revenue. The DRC produces roughly 70% of the world's cobalt, and that percentage has been growing over the past decade. During peak cobalt price years in 2018 and 2021, the country's cobalt exports exceeded $5 billion in value. That's not revenue to individual companies. That's the total value of cobalt exported from the country, generating royalties, taxes, and economic activity across the sector. For Lualaba Province specifically, mining is the economic backbone. The province is home not just to Mutanda, but to numerous other copper and cobalt operations. Tenke Fungurume, Komoto, Katanga Mining, and dozens of smaller operations. Mining represents perhaps 80% or more of provincial economic activity. Mutanda's production at peak represented a substantial portion of provincial GDP. When you account for direct employment, indirect employment in services and supplies, tax payments, royalties, and local procurement, the mine's economic footprint was enormous relative to the regional economy. The mine's royalties and taxes flow to both provincial and national governments. Under DRC mining law revised in 2018, the government holds a 10% free carried interest in mining projects, meaning they get 10% of profits without investing capital. Additionally, mining companies pay 3.5% royalty on cobalt based on mine head value. At peak prices and production, 27,300 tons at $66,000 per ton. That 3.5% royalty translated to over $63 million annually from Mutanda alone. That's real money even for a national government, and it's substantial revenue for provincial government budgets. Corporate taxes add another layer. Glencore pays a 30% corporate tax rate on profits from DRC operations. When Mutanda was highly profitable, generating perhaps $1 billion in EBITDA at peak, tax payments could have exceeded $200 million to $300 million annually. After deductions, these flows make mining projects like Mutanda critical national revenue sources. The infrastructure legacy is equally important and often overlooked. Mutanda's operations required massive power infrastructure investments, substations, transmission lines, backup generation capacity. These investments, while made privately by Glencore, benefit the broader region by expanding grid capacity and reliability. Road improvements connecting the mine to Kolwezi and eventually to export routes had to be maintained to handle the heavy truck traffic, thousands of truck movements monthly carrying supplies in and copper-cobalt products out. While mines pay for these improvements, they create public infrastructure that benefits other economic activities. The workforce development aspect cannot be overstated. 5,000 skilled mining jobs created training and expertise that elevated the regional labor pool permanently. Workers trained at Mutanda in equipment operation, plant operation, metallurgy, geology, engineering, and management took those skills with them when the mine closed. Many moved to other mines in the province, Tenke Fungurume, Katanga, Kamoa Kakula. Some started contracting businesses leveraging their expertise. Some moved to other mining provinces in Congo, or even to other countries. The human capital development from operations like Mutanda benefits the entire sector. But let's address the geopolitical dimension that makes Mutanda far more than just an economic asset. Cobalt is classified as a critical mineral by the United States, European Union, Japan, and other major economies. It's essential for battery technology, and despite intensive research, there are no easy substitutes for most applications. The concentration of cobalt production in one country, the Democratic Republic of Congo, creates supply chain vulnerabilities that deeply worry Western governments trying to build domestic electric vehicle industries. When you add that most DRC cobalt is refined in China, you get a complete strategic dependency that Western policymakers view as unacceptable. China has invested heavily in DRC cobalt processing and mining over the past 15 years. Chinese companies like China Molybdenum, Huayu Cobalt, and Zhejiang Huayu operate mines and refineries in the DRC. They control much of the cobalt hydroxide production that feeds Chinese battery cathode plants. Over 80% of global cobalt refining capacity is located in China, according to industry estimates. Raw cobalt from Congo might be shipped to China as hydroxide or intermediate product, refined to battery-grade cobalt sulfate or cobalt oxide, then incorporated into cathode materials for lithium-ion batteries, which are also mostly manufactured in China. This creates a strategic bottleneck in the global EV supply chain. A Western automaker building electric vehicles in the United States or Europe needs cobalt. That cobalt likely comes from the DRC, possibly from Mutanda. It almost certainly gets refined in China before reaching battery manufacturers, many of which are also Chinese companies. The United States government recognized this vulnerability and launched several initiatives to secure cobalt supply. The Defense Production Act has been invoked to provide government financing for domestic battery mineral processing. The Inflation Reduction Act includes provisions requiring North American content for EV tax credits. The Department of Energy has funded feasibility studies for cobalt refining in North America. The International Development Finance Corporation has provided loans for mining projects in friendly countries outside China's sphere of influence. But these policy initiatives face hard economic realities. The DRC has the ore grades, world-class deposits with 0.4% to 0.5% cobalt, 10 to 50 times richer than deposits elsewhere. China has the refining expertise and massive capacity built over decades. Companies like Glencore have the operational experience in challenging environments. Building alternative supply chains takes years and billions in investment with uncertain economics. Mutanda sits at the center of these tensions. When Glencore announced the mine closure in 2019, some analysts and policymakers speculated about hidden geopolitical motives. Would Chinese battery makers benefit from tighter cobalt markets? Did pressure come from Chinese partners? Glencore has consistently maintained the closure was purely economic. Cobalt prices below $35,000 per ton made operations unprofitable. The restart at $50,000 plus prices supports that explanation. But the speculation illustrates how sensitive cobalt supply has become to geopolitical interpretation. The export dynamics tell their own story about value capture. Mutanda's cobalt production ships primarily as cobalt hydroxide, an intermediate product containing perhaps 30% to 40% cobalt that requires further refining. The hydroxide goes to refineries, mostly in China, where it becomes pure cobalt metal or battery-grade cobalt sulfate, containing 20% to 21% cobalt. This means the highest value-added processing occurs outside the DRC. A ton of cobalt hydroxide worth perhaps $30,000 to $40,000 becomes refined cobalt metal worth $50,000 to $60,000 after Chinese processing. The DRC captures the mining margin, but China captures the refining margin, which can be substantial when markets are tight. The DRC government has pushed hard to change this equation. Regulations introduced in 2023 aimed to require more in-country processing, essentially mandating that cobalt be refined to metal or battery-grade chemicals before export. But building cobalt refineries in the DRC faces enormous challenges. Power costs are high and supply is unreliable. Technical expertise in complex cobalt refining chemistry is scarce in Congo. Infrastructure for managing toxic waste streams and reagents is limited. Access to specialized reagents and materials requires imports. Capital costs run into hundreds of millions of dollars for a single refinery. Several Chinese companies have built cobalt hydroxide production facilities in the DRC, essentially doing the first stage of processing locally. but full refining to battery grade mostly still happens in China, where established facilities, trained workers, environmental controls, and supporting industries exist. Now let's examine the reserves and resource base that determines Mutanda's future operating life, because mining is fundamentally about depleting a finite resource. Proven and probable reserves at Mutanda have been reported at over 200 million tons of ore containing approximately 600,000 tons of cobalt metal and roughly 2.5 million tons of copper. At 20,000 tons of annual cobalt production, that reserve base supports 30 years of operations at current production rates. That's a very long mine life, providing certainty for long-term planning and offtake agreements. But reserves are not static. They can expand or contract based on metal prices, technology, and further exploration. Reserves represent what's economically extractable today at current prices and costs. When cobalt was $30,000 per ton, lower-grade zones that were reserves at $60,000 per ton became uneconomic and dropped out of the reserve category. When prices recovered to $50,000 plus, those zones came back into reserves. The total mineral resource, which includes measured, indicated, and inferred categories beyond proven and probable reserves, is substantially larger at Mutanda. The resource base likely exceeds 1 billion tons of mineralized material containing over 1 million tons of cobalt metal. This distinction between reserves and resources matters enormously in mining. Reserves are what a company will actually mine based on current economics. Resources are geological potential that might become reserves as prices rise, costs fall, technology improves, or infrastructure develops. Think of resources as the upside option value. The ore body at Mutanda is part of the Central African Copper Belt, one of Earth's most spectacular base metal provinces, extending from southern DRC through northern Zambia. The geology here represents ancient sedimentary rocks deposited in shallow seas, later buried, metamorphosed, and mineralized by hydrothermal fluids. Unlike most copper deposits where cobalt is just a trace impurity at 0.01% or less, the copper belt deposits formed in unique conditions that concentrated cobalt to economically significant levels. The exact geological processes are debated, but the result is clear. Nowhere else on Earth has this combination of scale and cobalt grade. The cobalt occurs primarily as heterogenite, a cobalt oxide mineral, and various other cobalt-copper oxides in the weathered zone near surface. Deeper in the ore body, sulfide mineralization contains cobalt in different minerals like kerolite. The near-surface oxide ore is perfect for heap leaching. It dissolves readily in acid with no energy-intensive smelting required. This metallurgical advantage keeps costs at operations like Mutanda lower than they would be with sulfide ore processing. Sulfide ores typically require concentration, smelting, and more complex refining. The acid leaching, solvent extraction, and electrowinning route used at Mutanda is well-proven technology that Glencore has mastered across multiple Congo operations. Let's discuss the challenges and controversies that have shadowed Mutanda and the broader DRC cobalt sector, because no discussion of Congolese mining is complete without addressing the social and environmental issues. The elephant in the room is artisanal mining and the associated problems. Mutanda itself is a mechanized industrial operation with proper safety standards, formal employment, and environmental controls. Workers wear hard hats, safety glasses, and protective equipment. Equipment is maintained to international standards. Water treatment facilities handle acid drainage. But that's not the complete picture of cobalt mining in Lualaba province. The broader region includes thousands of artisanal miners, often called cruciers in French, working small deposits with hand tools, often in dangerous conditions with no safety equipment. These artisanal operations produce perhaps 15 to 20% of Congo's cobalt, and the conditions are frequently appalling. Reports from organizations like Amnesty International, Human Rights Watch, and various United Nations bodies have documented child labor, unsafe working conditions, leading to deaths and injuries, environmental degradation, and exploitative buying practices in the artisanal cobalt sector. These issues don't directly involve Mutanda or Glencore, but they taint the reputation of all DRC cobalt. Battery manufacturers and automakers have responded with supply chain auditing initiatives, trying to ensure their cobalt doesn't come from artisanal sources with these problems. The Responsible Minerals Initiative and similar programs aim to verify that cobalt comes from operations meeting international labor and environmental standards. Glencore has implemented supplier codes of conduct and third-party auditing at their DRC operations. The company maintains that Mutanda meets international standards for labor practices, safety, and environmental management, and they publish annual sustainability reports documenting their practices. But the challenge is that cobalt supply chains are complex. Mutanda produces cobalt hydroxide that goes to refineries, which might also process artisanal cobalt purchased from Congolese traders. Once metals are mixed in a refinery, tracing back to specific sources becomes difficult. Battery makers struggle to guarantee their cobalt is entirely from industrial, audited operations. Environmental challenges at Mutanda Center on water management and acid rock drainage. Open-pit mining operations inevitably disturb large land areas. Heap leaching operations generate large volumes of acidic water from irrigating ore heaps with sulfuric acid. This water must be carefully managed to prevent environmental contamination of streams, rivers, and groundwater. The mine operates water treatment facilities to handle processed water and runoff, neutralizing acid and precipitating metals before discharge. Tailings and spent ore from heap leaching must be stored securely to prevent ongoing acid generation and metal leaching. These environmental management systems require ongoing maintenance and monitoring. Community relations have been another persistent challenge. Large-scale mining inevitably creates tension with local populations over land use, employment, environmental impacts, and benefit sharing. Mines occupy land that communities previously used for farming or gathering. Dust, noise, and traffic affect nearby villages. Glencore invests in community development programs around Mutanda: schools, healthcare facilities, roads, water infrastructure, and agricultural programs. These investments are partly genuine corporate social responsibility and partly necessary to maintain operating licenses and community acceptance. But expectations often exceed what mining companies deliver. Communities see billions in mineral wealth leaving their region and want a larger share. When mines close, as Mutanda did in 2019, communities lose benefits, but are left with environmental legacies and depleted land. This creates frustration and occasional conflict. The political dimension adds another layer of complexity. The DRC has experienced periods of political instability, and mining regions like Lualaba province have strategic importance to whichever faction controls the national government. Minerals generate the forward exchange the government needs. Mining code revisions in 2018 increased royalty rates substantially and imposed new requirements on mining companies. For cobalt specifically, the royalty jumped from 2% to 3.5%. Additional provisions required mining companies to pay export duties and limited the ability to deduct costs. Glencore and other operators negotiated implementation details with the government. These negotiations highlight the ongoing need to manage political risk. Governments can change laws, impose new taxes, demand renegotiation of mining contracts, or even threaten expropriation. Companies need good relationships with government officials at national and provincial levels, which sometimes involves difficult ethical territory. Currency and financial controls create operational challenges. The DRC uses the Congolese franc, which can be volatile, and has depreciated significantly over time. Mining companies prefer to operate in US dollars, paying workers and suppliers in dollars, selling product in dollars. This creates constant tension over currency conversion, export procedures, and capital repatriation. Infrastructure limitations constrain the entire Congo mining sector and affect costs at all operations. Power is expensive. Electricity in Congo can cost 2 or 3 times what it costs in South Africa or Zambia. Supply is sometimes unreliable, forcing mines to maintain expensive backup diesel generators. Roads deteriorate during rainy seasons, which last months in tropical Congo. The journey from Mutanda to export ports requires trucking or rail transport across thousands of kilometers to Durban in South Africa or Dar es Salaam in Tanzania. Any disruption, rain damage, political protests, border delays, affects logistics and costs. These infrastructure gaps raise operating costs substantially and create logistical headaches. A mine might produce metal profitably at the mine gate, but moving that metal to export markets adds costs that can erode margins. This is why high-grade operations like Mutanda can succeed where lower-grade deposits would fail. The margins are large enough to absorb infrastructure costs. Looking forward, what determines Mutanda's future over the next 5 to 10 years? The most obvious factor is cobalt price, which fluctuates based on supply-demand balance. Current prices around $30,000 to $35,000 per ton in 2025 make operations viable, but not spectacularly profitable. If electric vehicle adoption accelerates faster than cobalt supply growth, prices could surge again to $50,000, $60,000, or higher per ton. At those levels, Mutanda becomes extremely profitable, and Glencore would likely push for maximum sustainable production, potentially returning toward 25,000 tons annually. But technology trends could undercut demand substantially. Battery manufacturers are actively working to reduce cobalt content in lithium-ion batteries. Tesla's newer battery designs use high-nickel chemistries with minimal cobalt, perhaps 5% cobalt compared to 20% in older battery designs. LFP batteries, lithium iron phosphate chemistry, contain zero cobalt and are gaining market share in lower-cost EVs. If cobalt-free or low-cobalt batteries become dominant, demand growth could stall or even reverse despite EV production growth. This technology risk hangs over every cobalt investment, including Mutanda. Companies are researching this risk intensively, and the uncertainty affects long-term cobalt price forecasts. However, even with reduced cobalt intensity per battery, the sheer scale of EV production growth may sustain total cobalt demand. Industry analysts project total battery manufacturing capacity, reaching terawatt-hours annually by the 2030s, 10 times current levels. Even with lower cobalt content per kilowatt-hour, total cobalt demand could continue growing substantially. Glencore's corporate strategy around Mutanda appears focused on flexibility: run the mine when economics support profitable operations, suspend when margins compress, restart when markets recover. This optionality is valuable precisely because cobalt markets can be volatile, with price swings of 50% or more within a single year. The company has also been working to expand its customer base beyond traditional cobalt users. Direct supply agreements with battery manufacturers provide more stable demand than spot market sales. Glencore has announced long-term supply deals with Tesla, Samsung SDI, BASF, and other major battery and chemical companies. These offtake agreements typically lock in prices using formulas based on market indices rather than fixed prices, but they provide volume certainty and relationship stability. For Mutanda, securing long-term contracts at acceptable prices de-risks production and justifies continued investment in the operation. Capital investment at Mutanda continues even during current operations. Mine plans evolve as new drilling defines ore bodies. New pits open as existing pits deplete. Processing circuits get upgraded to improve recoveries or reduce costs. Infrastructure expands as production areas shift. Glencore has indicated willingness to invest when projects deliver acceptable returns. One potential development that could transform Mutanda's profitability is downstream integration. Could the operation add refining capacity to produce battery-grade cobalt sulfate on-site rather than shipping intermediate cobalt hydroxide products? The economics would depend on power costs, technical capabilities, and market access. The DRC government would strongly support such an initiative. Capturing more value-added processing in-country aligns perfectly with resource nationalism objectives and could generate additional tax revenue and hundreds of skilled jobs. Chinese battery companies might finance such a refinery to secure supply. Exploration around Mutanda continues to identify extensions of known ore bodies and potentially new deposits. The broader mining license area covers 1,850 square kilometers, with only a fraction systematically explored by modern methods. Drilling programs, test targets, and positive results could add to mineral resources and eventually reserves. Technological improvements in extraction and processing can also boost economics. More efficient leaching that dissolves more metal from ore, better metal recovery rates in solvent extraction, lower reagent consumption, reducing operating costs. These incremental improvements can add millions to annual EBITDA. Glencore invests in process optimization across all operations. The biggest wildcard remains geopolitical. Will Western governments and companies succeed in diversifying cobalt supply away from DRC dominance? Or will geological and economic reality keep the Copperbelt as the world's primary cobalt source for decades? The answer affects Mutanda's long-term strategic value enormously. New cobalt projects in Australia, Canada, and the United States face higher costs and lower grades than Mutanda. Even if some reach production, displacing DRC cobalt entirely seems unlikely. The world may need both Congo cobalt and alternative sources, similar to how global oil markets include both Middle East crude and North American shale oil. For Glencore shareholders, Mutanda represents a real option on cobalt demand growth. The mine can scale production up or down based on market conditions, flexibility that most mining operations lack. This operational flexibility has strategic value in volatile commodity markets, providing downside protection when prices fall and upside leverage when prices rise. The closure in 2019 and restart in 2022 demonstrated this flexibility in action. Glencore managed to avoid losses during the price crash while positioning to capture upside when markets recovered. Few mining companies have assets that can be turned on and off this way without destroying value. Here's something most observers miss about Mutanda's strategic importance. This isn't just about the 20,000 tons of annual cobalt production. It's about the credible threat to restart production at any time. This threat alone influences market behavior and prices. When cobalt prices spike above $60,000 or $70,000 per ton, everyone in the market knows Glencore could bring Mutanda's massive production back online within 6 to 12 months. This overhang caps price rallies. Buyers won't panic buy at $80,000 when they know 20,000 more tons could hit the market soon. When prices crash below $30,000 per ton, everyone knows Glencore could idle Mutanda again, cutting supply by 20% and putting a floor under prices. This floor supports prices. Producers are less likely to engage in destructive price wars when they know the marginal producer can shut in supply. The mine functions as a market stabilizer simply by existing, even during periods when it's not producing. Few other cobalt operations have this kind of market influence. This is the real power of controlling 20% of global supply from a single asset that can be started and stopped strategically. Think about the parallels to other commodity markets. Saudi Arabia's ability to adjust oil production quickly influences global crude prices. Everyone knows the Saudis can add or cut 2 or 3 million barrels daily within months. BHP's giant iron ore operations in Western Australia affect seaborne iron ore markets similarly. Mutanda plays an analogous role for cobalt. The difference is that cobalt markets are much smaller than oil or iron ore. Total annual cobalt trade is measured in single-digit billions of dollars, not hundreds of billions. This smaller market size amplifies Mutanda's relative impact. One mine's decisions move the entire global market materially. For the Democratic Republic of Congo, Mutanda remains a symbol of both opportunity and challenge. The mine demonstrates the wealth that mineral resources can generate, billions in revenue, thousands of jobs, hundreds of millions in government revenue from a single operation. But it also highlights dependency on external companies, foreign markets, and volatile prices. When Glencore decided to suspend Mutanda in 2019, the Congolese government could object, but ultimately couldn't force continued operation. Economic power resided with the operator who controlled the capital and expertise. This tension between national sovereignty over resources and economic reality defines resource-dependent economies worldwide. The DRC legally owns the minerals in the ground, but needs foreign investment and technical expertise to extract value. That creates dependencies that limit policy options and force uncomfortable compromises. The future may bring changes to this dynamic. If the DRC develops more domestic technical capacity, builds more in-country processing capability, and attracts more competing investors to create a deeper mining ecosystem, the balance of power could gradually shift. For now, operations like Mutanda represent the current model: foreign-owned, export-oriented, shipping intermediate products for processing elsewhere. This model generates revenue and employment, but leaves the country dependent on decisions made in Swiss boardrooms and exposed to Chinese refining dominance. Let's bring this back to what it means for you watching this video. Every time you drive an electric vehicle, charge your laptop, or use your smartphone, you're connected to operations like Mutanda through the cobalt in those batteries. The device in your hand contains atoms that were mined from the ground in Congo. The energy transition everyone talks about, the shift from fossil fuels to electrified transport and renewable energy, depends absolutely on battery technology. And battery technology, despite decades of research, still depends substantially on cobalt. And cobalt depends on places like the Copper Belt that have the unique geology. This creates an interesting and uncomfortable paradox. The green energy transition, meant to solve environmental problems in wealthy countries, depends on mining operations in one of the poorest countries on Earth. The sustainability of electric vehicles rests ultimately on the geology of Central Africa and the willingness of companies to invest there. Understanding this reality matters for investors, analyzing battery metal companies and EV manufacturers. It matters for policymakers trying to build resilient supply chains, and it matters for consumers who want to understand what their purchasing decisions truly support. When Glencore announces Mutanda production guidance, battery manufacturers adjust procurement strategies. When cobalt prices spike, automakers reconsider battery chemistry choices and design decisions. When the DRC changes mining regulations, global supply chains feel the impact within months. The financial markets reflect these dynamics in real time. Glencore's stock price, which you can follow on the London Stock Exchange, correlates strongly with cobalt price movements. Battery metal ETFs track cobalt alongside lithium and nickel. Investment flows respond rapidly to perceived supply-demand balances and geopolitical risks. Here's the climactic revelation about Mutanda that ties everything together. This isn't really a story about one mine in Africa. It's a story about how the entire global economy is reorganizing around electrification and decarbonization, and how that reorganization creates new dependencies that look remarkably similar to old oil dependencies. That reorganization requires massive amounts of specific materials: lithium, cobalt, nickel, copper, graphite, rare earths. Unlike oil, which can be produced in dozens of countries, these battery materials concentrate in specific geological provinces. You can't drill for cobalt anywhere, like you can drill for oil. The DRC's cobalt deposits formed over hundreds of millions of years through unique geological processes that occurred nowhere else on Earth at this scale. You cannot create new deposits through technology or policy. You cannot legislate better geology. You work with what the planet provides. This means the green energy transition creates new resource dependencies that look remarkably similar to the old oil dependencies. Everyone wants to escape. Instead of Middle East crude, we have Central African cobalt. Instead of OPEC controlling supply, we have companies like Glencore controlling critical mines that can reshape markets with single decisions. Mutanda stands at the intersection of these global trends, where geology meets economics, meets geopolitics, meets technology. The mine represents a natural choke point in supply chains that power the 21st century economy. Understanding Mutanda means understanding how resource extraction still shapes the world, despite all our technological advancement. The numbers we discussed earlier: 1.8 billion in annual cobalt revenue, 27,300 tons of peak production, 20% of global supply. These aren't just statistics for a YouTube video. They represent economic power translated into market influence and strategic leverage. When one company controls that much of a critical material with no easy substitutes, they can shape not just prices but entire industry strategies. Battery manufacturers are working desperately to reduce cobalt dependency, partly because they fear the concentration risk that operations like Mutanda represent. Glencore's decision-making around Mutanda thus ripples through global markets in ways few other mining operations can match. The closure decision in 2019 sent signals to everyone from Tesla to Chinese battery startups to mining exploration companies worldwide. Markets adapted, investment decisions changed. The restart decision in 2022 sent equally powerful signals. Cobalt prices adjusted immediately. Competing projects reassessed their economics. Long-term supply contracts were renegotiated. One mine in Congo influenced strategic decisions by companies and governments on every continent. Looking ahead to 2026 and beyond, Mutanda's story continues evolving. Production rates will fluctuate with market conditions. Glencore will optimize the operation for maximum returns. The DRC government will push for higher royalties and more in-country processing jobs. Technology will advance. Battery technology will keep advancing, potentially reducing cobalt requirements per kilowatt-hour, but total battery production will keep growing exponentially as EVs displace internal combustion engines. These opposing forces, lower intensity but higher volume, will determine whether total cobalt demand grows or plateaus. New cobalt projects will enter production in other countries. Idaho Cobalt in the United States, various Australian projects, potentially Canadian deposits. But few will match Mutanda's scale, grade quality, or cost structure. The Copperbelt's geological advantages persist regardless of policy preferences or geopolitical tensions. What we can say with confidence is this: as long as batteries require cobalt at current levels, Mutanda will matter strategically. The mine sits on geology that took hundreds of millions of years to form and cannot be replicated elsewhere. That geological reality translates directly to economic power and strategic influence. The workers who operate Mutanda, the communities around it, the Congolese government that regulates it, the Glencore executives who manage it, and the global customers who buy its output, all are connected through cobalt economics that extend from African pits to battery factories to EVs worldwide. This is mining in the 21st century, not just extracting rocks but controlling supply chains that enable entire industries, not just producing metal but influencing technology development trajectories and geopolitical strategies, not just running a mine but holding leverage over the energy transition. So the next time you read headlines about electric vehicle sales hitting new records or battery technology breakthroughs enabling longer range, remember Mutanda. Remember that beneath those market trends sit geological realities, mining operations, and corporate decisions that make technology adoption possible. The story of Mutanda is ultimately about power, the power that comes from controlling scarce resources that the world desperately needs. It's about how geology becomes economics, becomes geopolitics in the modern interconnected world where supply chains span continents. And it's about understanding that the energy transition everyone celebrates as progress requires mineral resources that concentrate in specific places, controlled by specific companies. That dependency creates both opportunities and vulnerabilities that will shape global economics and geopolitics for decades to come. If you found this deep dive into Mutanda valuable and want to understand more about how mining operations shape the modern economy, you'll want to see our next video. We're covering the geopolitical battle for lithium in South America, where 3 countries control the resource that powers every battery on Earth. We'll show you how the lithium triangle creates dependencies that rival anything in the cobalt market. Make sure you're subscribed so you don't miss it.